So we're going to kick off in a very original way by asking you all to just take 2 minutes to tell us a bit about yourselves and about your companies and what it is that you do. We can start with Cameron on the end there if you want.
Great. Brilliant. Thanks, Elliott. I'm the founder of Prodigy Finance. So we set out to solve what was a clear pain point for people who are traveling across borders. So anyone who's going to study internationally, so you're coming from Ghana, you're going to Stanford or Oxford, getting access to loan funding is incredibly difficult because banks think about risk in a really localized way. So if you arrive, at Stanford from Ghana, the bank doesn't know how to risk assess you in the States, doesn't know how to think about you when you move back to Ghana, how to collect from you when you move back. So that kind of localized banking makes it extremely difficult for someone who's crossing a border. And it's not just students. There's 250 million people living outside of their home country. It makes it extremely friction-filled to be able to get a loan to fund your education. So what we have is a marketplace in which we fund students currently from 120 different countries. We've funded about just over $500 million so far, and we have a fantastic repayment rate, really sort of proving out the model that we can risk score and this group of people does repay. The funding of that comes from a variety of sources. So we have crowdfunding to the alumni networks of the school. So for example, alumni from Oxford will fund the next generation of students for return, as well as additional funding from other institutions. We're between London, our tech and operations in Cape Town, and a small office in New York.
So I'm Shivani. I'm the CEO and founder of Tala. I want to start with actually talking about the problem that we're solving and our mission. So the problem that we're solving is that about 3 billion people around the world are currently underserved from financial services and financial institutions. And something that I learned while I was actually doing the research for this was actually that only about 31% of the adult population is actually covered by a credit bureau. And so the problem that we're really focused on right now is figuring out how can we provide financial access, choice, and control to the underserved, mainly in emerging markets. So what we developed is a smartphone application that allows an individual to download our app, apply for a loan, and receive an instant decision regardless of their financial history. And so the kind of data that we're bringing in is really everything from smartphone daily life data, but actually more proprietary data sets as well that focus on behavioral daily life information that actually relates to all of us. So right now, Tala is working across East Africa, the Philippines, Mexico, and then our main office is in Los Angeles, but we do have teams in each of these markets. We've dispersed over $250 million US now in capital in the last 2 years. And we just crossed about 1 million customers on the platform last week.
Congratulations. Geoffroy.
Hi, my name is Guigou, so I'm the co-founder of Younited Credits. So we might be one of the biggest French fintech as of today by the number of employees, so 210, among which 60 at tech. And by the amount of equity we raised, so 100 million euros. Basically, we are an online lending platform operating in 5 countries, so France, Italy, Spain, Germany, and Austria. And we'll be passing the threshold of 1 billion euros in cumulative loans since inception this year. What distinguishes us from other online lending platforms over the world and what makes us unique is actually our credit institution license. So we have a full ECB credit institution license, enabling us to go in 28 countries and also to collect term deposits on our balance sheet. So basically, I think we are closer from what Goldman Sachs is going with Marcus than from other traditional online lenders. Apart from B2C, we have launched a B2B2C offer in December. So our online lending platform is fully accessible through APIs and enables players like insurers, neobanks, online banks to launch a consumer loan business in a matter of months, so less than 4 months. And we've launched, for instance, the first partnership with N26. So N26 clients in France, when they apply for a consumer loan, it's originated and supported by Younited Credit.
Okay. And Geoffroy, I think, if I'm not mistaken, you're the first French fintech to appear on stage at this year's Fintech Forum. So I'm going to start with you. How is 2018 looking? What should we expect this year from Younited Credit?
Well, it would still be a year of huge growth, so we want to maintain roughly 100% growth in revenues and origination year on year. So given the size of the company, it gets more and more a challenge after the years pass, of course. So it's still a year of huge growth. On the product side, we'll be launching our instant decisioning loan this year, which is quite a huge innovation in France and in Europe also on consumer loan of that size, average size between 5,000 and 6,000 euros. And last point is developing partnerships. So we have a huge demand from neobanks, online banks that want to access our technological origination platform. And basically, since our license is passportable across Europe, I think that we are the only one which can answer their needs. There are huge revenues on consumer loans. Many players, online banks, neobanks, have low revenue model, so we can, of course, partner efficiently with them.
And it's just the neobanks and the kind of new kids on the block that are trying to partner with you, or any of the incumbents?
Not only,
as well?
we are about to launch several offers of consumer loans in France and in other countries, including Italy, with more like traditional insurers.
Okay, Shivani.
When I think of kind of what comes next for us, I think obviously there is continued geographic expansion. So we are looking at other markets in Latin America, Southeast Asia, as well as South Asia, because it is really exciting to see that a lot of these governments are pushing financial inclusion and actually creating the infrastructure now for products like ours. But I also think of it more as vertical expansion. And so thinking about how can we use the understanding of these customers and the data that we have to further that relationship. And so we are looking at products in savings, insurance, financial education, as well as, I would say, longer term kind of investment products as well.
Maybe student loans, we'll see about that. But Cameron?
Yeah, for us, I mean, I think the challenge for us has always been compared to if you look at a domestic fintech player, where accessing the challenge you're solving if you're in a US domestic market or a UK domestic market, or even perhaps a French context, is the risk is fairly well understood. You can innovate on it, but you have a fairly decent credit bureau in which it's pretty homogenized, so that you can go to a wholesale source of funding or to investors and say, can you lend through my platform, because look at the risk, here's a bureau score for 5 decades. Whereas for us, we started off saying, hey, we want to think about this for the world, and let's go completely borderless from day one. No one had done that before, and what that means on the funding side is that really you have to prove out the model with your own data, because there's no proxy. You can't go to wholesale funding sources and say, you guys will understand the risk, look at X from the bureau. You really have to spend the time in building the track record. And so for us, all of this time has been about proving that our model works across these 120 countries, and then scaling the funding, because we face more demand than we have a supply of capital. And so we're now at the point, and I think it's sort of at the transitional point now, where the model, we've got enough data to be able to show the model works in quite a robust way. And really this year is about getting to proper scalable sources of funding to increase us. So we've been spending a lot of time on that. There's a few elements of that. So one, from the wholesale side, we've had a partnership with Credit Suisse in distribution to private wealth, which has been really helpful. It was a very nice collaboration. We've done about $180 million with Credit Suisse private wealth, which has been great. And so this year, I'd say for us, is really solving the point of funding will no longer be a constraint. We're going to get to into the billions on the funding side, in which we have that locked in and unlock that. I think that's really our focus for this year. Separate to that as well, we are thinking about additional partnerships that solve some friction points. So when you arrive in the US, you're coming from India or Ghana, you can't get a bank account, you can't get a credit card, you can't get any form of access. So we're looking to partner with a few people, not to do it ourselves. This is just sort of to think about someone who can solve those problems for our customers. Okay,
so Shivani and Cameron, you both mentioned data here and the importance of models. So Cameron, you and I were chatting quite a lot last night about a bit of an exercise you had to kind of go through. Just tell us just how challenging it was to kind of show, first of all, to build the models, and second of all, to prove that they actually work? Because as you say, you are effectively starting from scratch.
So, I mean, the challenge was definitely real. We came at it pretty optimistically when we started, and we were saying, hey, you're gonna understand this. We're taking the best of the best people from around the world. They're going to the top universities. Obviously, you want to back them, and it's going to make sense. But obviously, the response back from that is, yeah, that sounds amazing. Let's see how that's all going to work out. And so all of our funding initially came from crowdfunding to the alumni. So saying, hey, you understand it. You went to Oxford 10 years ago. Like, you'll at least get what we're doing, and you can think about earning a return from it. But the challenge for us was not just the data. I mean, the data is absolutely a key and being able to show that the model works. But then you've got additional issues operationally in trying to enable repayments across multiple countries when you're coming back, and then equally in being able to enforce across multiple countries. So no one had thought of a model in which you need to enforce a loan contract, because our loans are fairly significant. We're a $40,000 loan, so with a 5-year time horizon. So it's a significant loan. And no one had really thought about sort of enforcement across multiple countries. So
how do you enforce someone in India or Brazil or Ghana or wherever they are, they've borrowed $40,000 on your platform, and then they kind of go back, maybe a parent falls ill, or maybe they don't want to pay you. How do you enforce in countries where, let's face it, the judiciary isn't always up to the same standards that perhaps we're accustomed to in Europe?
So, I mean, I think, the first point is if I never meet another lawyer in my life, I won't be unhappy about that. We've managed to certainly work with a number, but just practically, what you're looking at in credit, obviously, is can someone repay, and if they can repay, will they repay? I mean, it's the same for anyone, but for us, we do two things on that. So we look at the can you repay by using the data, including data we get from our university partners, to understand what exit earnings are. So for example, the various factors in your profile when you're going to study X degree at XY university, what is it that's going to determine what you're going to be earning after graduating, including where you're going to move, because most of our students move back to their home country or region, and we like that. We like the impact of that. But we're trying to assess not based on their current income, as you would in a normal lending platform, but what are they going to be earning in the future, and quantifying that. It's not sort of a fuzzy assessment. It's saying, really, what is the band going to be that we can lend to them affordably? So that's the first part. So making a loan which someone can afford to repay. That's the first step. The second step is then enforcing if someone, just chooses not to and goes AWOL because they think that they can get away with it. And we spent a massive amount of time and cost setting up a enforcement framework to enable enforcement across these 120 countries. We thought initially, I don't know how, we thought that would be fairly simple. It wasn't. We did an exercise last year in which one of the institutions who invest in our platform asked us to validate this model. They said that they'd forced Uber to do the same thing, so we felt okay about this because they told us it would take 6 weeks. It took a year with 118 sets of local counsel. It was a nightmare to do, but it's great that we have it now because it means that we've got a very sort of validated enforcement framework across all of these countries, which is pretty unique to us. So a lot of pain, but nice to be there now, I guess.
Okay, Shivani. If you can remember what the question was originally now, so it was more about how you kind of start from scratch where there's no data there to kind of build on, and how you kind of build these models and show that they actually work.
I think it's very similar in the sense that, again, we are building from scratch. In some sense, it's like building completely from scratch because there has never been data on these customers. And so what we had to do was similar is, go get the outcome data and work backwards. So in every country that we go into, even if we're bringing in global fraud models now, we are actually having to start with doing blind lending and then retraining that first loan model. I think what we do that's a little bit different is that we think of it as there are 3 steps for us. The first step is really around identity verification and fraud. And we have this hypothesis that if we can actually take fraud out of the system, then we should be able to lend to about 95% of the population. And we believe that the real true use of data science and the data that we have would be in pricing and segmentation. So really thinking about how do you customize your credit product to the market that you're serving as opposed to not lending to the population. So our approval rates are above 70% across our markets. Because really our mission is a company that is trying to create more financial access in the population. In terms of the data piece, I think that's also where it's been interesting because we've actually had to come up with proxies for income as well as consistency of expenses. So very, interesting points that we found have been, how does someone actually use their device? How much do they spend on data? How many phone calls are they making? What does the number of text messages back and forth show us? Because that is, again, a way of thinking of liquidity. So we can kind of back into these kind of different proxies. And then the last thing I would say is around identity and fraud. I think that goes into, again, this aspect of if you're in the application, if we set it up in such a way that it is almost like a game that you are going through, each decision that you make tells us something about your character and the way that you may repay your loans.
And I think you were also telling me that you try to strip out any biases that the system might have, because traditionally, I think, if I'm not mistaken, when it comes to microcredit in some of these markets where you are, traditionally they would try to give the money to the women because they're less likely to squander it on alcohol or on whatever the case may be. But you try and kind of even strip out even gender from your models, you were saying.
We do. Again, because of the fact that we don't want to just create the next generation of black boxes. We want these models to actually be explainable. And in that sense, you need to control the variables that you're actually putting in. And so I've given our data science team a very hard task and said, things like gender, religion, race, where you're from, the number of languages you speak, these can all have biases. And so we've taken those kind of easy things that do correlate with repayment out and then actually forced ourselves to come up with more interactive variables and understand the stories, I would say, behind each data point.
And Jeff, well, obviously you're not in emerging markets, you're across Europe. I think Cameron was suggesting it's easier for you to kind of use the data that's kind of already out there from the past 5 decades to kind of work out your ideal models. Presumably it's still pretty tricky.
Yeah, I think it's always tricky in consumer loan business, also in developed countries, I would say. All the more so as we are in different countries. So we are originating loans in France, Italy, Spain. When you have a look at online lending platform, the leaders in each country to consumers, they are only in one country. So US leader only in the US, UK leader only in the UK, Chinese leader only in China. And our choice was to really go abroad and be maybe the first really global online lending platform. In each of those countries, France, Italy, and Spain, there are or there are not credit bureaus. In France, you don't have any credit bureau, so it's very difficult when you launch from scratch. Our response was twofold. The first one was to be extremely cautious regarding volumes, so we accepted to do only 10 million euros in loans during the first year, so 2012 is very small. And on the other side, we also added some more stringent underwriting processes. So from instance, we required every applicant to give us access to his bank accounts, so the last 1 or 2 bank statements, even for very small loans of 3,000 euros. In France, our competitors, they ask for the bank statement from 10, 15 K euros. But we had to ask them from 3K euros, so very challenging to build this. And as a matter of fact, the first update of our scoring model for France could be done 5 years after launch. So during the first 5 years, we did not have enough data to improve or significantly refine the model. It also showed that it's a business where you have to take low risk at first, have a lot of equity to pass this quite long period, and then you are in the virtuous circle of credit institution when you can improve models. I think that going forward, next years, DSP2, PST2 will be a huge lever for improving those underwriting models. And as of today, with many partners, we already access to the bank accounts of the clients over the last 6 to 12 months. And so we are building already quite advanced model using all this data, and this will clearly revolutionize our industry. And I think within 10 or 15 months, we'll be able for some clients to offer rates which are really lower than what they can get through their bank, their bank branch.
Okay, I want to ask a slightly broader question. Interest rates are still at or near historic lows. Cameron, you get people investing. Obviously, they want an impact, but they want a return. Is that the same with the Tala platform, that you get people investing money to provide you with the funds to rent out? And obviously, yours is a consumer lending place, so people are also coming to your platform to lend money to get good returns. What happens when interest rates rise, let's say to normal levels, quote unquote, and people can get decent returns elsewhere, perhaps without as much risk?
Sure. So, I mean, I think for us, obviously you've got an issue if you had a massive catastrophic rise in interest rates, which we don't really expect. Then everyone's in the sort of same boat, and it starts to become a credit question, because if the rates go so high that it makes repayment unaffordable, people can't take your loans. That's a bit more existential. But for us, really, the segment that we're targeting, because it's really unusual, because it's a super premium segment. These are really great people, and they don't have access to other options. That's why we exist. And so a 2-3% rise in interest rates on our customer side isn't really much of an issue. On the other side of that, on the investor side, all of our rates are variable, linked to the base rate. So again, I think it's very much sort of, I don't see that a couple of percent rise in interest rates is going to suddenly make all other alternative investments
more desirable.
More desirable. I think you can start to question once it goes beyond that, but I don't see why it would change the dynamic for us. We're offering a decent relative return right now, and we'll continue to do that, even if it's 2%, 3% higher.
Shivani?
I think what's interesting of ours is that our product itself, the average duration is about 30 days. And so in that sense, the capital is turning over about 12 times a year for us. And so even if the rate was to go up a little bit, we can actually support that.
And just to clarify, if I recall correctly when we were speaking, you'll charge, say, the average rate of, what was it, 7 or 9%, I think you said? But it's not like it doesn't accrue. Like if after 30 days they haven't repaid, it's not like it compounds or anything else like that. It's not like it's a 84% APR. That's what it is. That's what they pay for the duration of their loan.
Exactly. It's better to think about the product almost as a flat fee product that stops. I mean, even if you pay us back in 60, 90, it's the exact same fee.
Geoffroy?
Yes, I think exactly the same. To be very honest, we're waiting for the rates to go high. We'll be waiting this for quite a long time. So, but it will be a good news when it arrives. As of today, let's take an example. If we are lending to consumers with an APR of 6 and the lenders get an expected return of 3, okay. Now, if we lend at 8 and the lenders get an expected return of 5, it's the same for us. So, and I think it will be even better because our revenues are a kind of upfront fee, which is a share of the APR. So for a given upfront fee, it will represent a smaller part of the APR if the rates go high. The question, I mean, is not really about rates going higher or not. It's more linked to the economic situation. If rates go high, there are fear that, or it could be linked to an increase in unemployment rates. And we have been very lucky in France to launch our model in a stress period, I would say. So unemployment rates, they grew from 8% to 10% roughly in France over the last 5 years. So we stressed our model, and it's very different from situation in the UK and in the US, for instance, where unemployment rates decreased from, let's say, 10 to 5% over the last 5 years. And then there is the question is, what if unemployment rates go higher? On consumer loan, unemployment rates, of course, are a major driver of default rates.
Mm-hmm. Okay, so we haven't got a huge amount of time left, so I've got some kind of individual questions specific to your startup. So I'll start with you, Shivani. If I read correctly on your website, you use thousands of mobile data points to help customers build their kind of financial identities. But you're in countries like, you're in Kenya, Tanzania, Philippines, and Mexico. So say somewhere like Tanzania, maybe the figure I read was wrong, it was talking about a 13% internet penetration rate. I think you said it could be as high as 30% or something like that. But when you have such a low internet penetration rate, how do you get the data, given that that internet penetration, if anyone's not au fait with the definition, we're talking like if a person has gone online once in the previous 12 months, that counts as having penetrated the internet, so to speak. So in terms of that, how do you, in a country like Tanzania, with such a low internet penetration rate, find the volume of customers in order to get the data to enable you to loan them money?
So I think this goes into how do you localize your product and find that product market fit. One thing that we told ourselves is that if we have this global mission, then we need to put constraints around ourselves, which means we can't have feet on the street. We're not doing brick and mortar locations. Everything that we do end to end is digital. And so in that sense, the way that we acquire the majority of our customers is actually through digital channels, just like the way we do in any country. If you have a consumer app, you're advertising on Facebook, on Google AdWords, on Twitter. We obviously also use local ad networks. But then what's exciting and interesting is that as the product actually starts to get traction, our biggest channel of customers coming in is actually referrals and organic traffic. And so that goes back to saying, if that's going to be your biggest and cheapest source, then how do you build your data models in such a way that you can actually, as a lender, allow organic customers to come in? Because we usually consider those as fraudulent. But in our system, we actually kind of sway more towards organic. So that's one way, is thinking, I think, of the community-based approach and getting that word-of-mouth traffic actually happening.
Okay, Geoffroy? Sorry, my question for you, my slightly different question for you, Geoffroy, is there was an op-ed last week, I think, on Bloomberg View, talking about the lack of competition in the French banking industry and how they kind of play it safe and they loan to kind of safe bets. I'm just wondering if this lack of competition either A, means that it's a great place for a disruptive fintech like yourself to come in to shake things up, or if it means that all the good credit risk is kind of snapped up by the banks and they just leave you with the slightly riskier ones.
France clearly, and we learned this 5 years after launch, is the toughest market on consumer loans in Europe. So it's very difficult to enter, to get the license, no credit bureau, and then when you're in the market, margins are very low. So that's the reason why we are going abroad to Italy, Spain, for instance, and other countries to be launched this year, where margins are really much higher. I don't think that competition in France is very low. There is fierce competition. BNP Paribas and Crédit Agricole consumer loan subsidiaries are two of the three European leaders. So we are here in the country where you have the two of the three European leaders. So market is quite tough. And we want to be on online lenders to take this inspiration from French players and to be the European leader among online lenders.
Okay, well, we'll be hearing from the Banque de France governor very, very shortly, but I want to finish with you, Cameron. I learned from your FAQs on your website that if I'm a resident in Belgium or Sweden or Montana and 18 other US states, or I want to do a postgrad in, let's say, communications, and there are some people who do that, I can't get a loan from Prodigy. Is that fair?
Definitely not. I'm trying to imagine what that would look like if you put those all together in Montana. But I mean, the reason is what I was saying about some of the regulators are not particularly progressive. So, for example, in our entire global study of these 118 countries, we had green lights from pretty much everyone except for Belgium and Sweden, and then there's one or two US states which just have really strange quirks. And no matter how much we explain to the Belgian regulator, listen, we're providing a service for Belgian people who are moving out of the country to the States or wherever it is, and they don't have an option because the Belgian banks aren't lending to them. They weren't hearing it. So unfortunately, we do live in a world of regulatory restrictions. We've had to be very thoughtful about how we navigate that. Now you've got some interesting, when you talk about what's hot in 2018, obviously some blockchain-enabled things are extremely hot in 2018, a little bit too hot in some areas. But the technology underpinning that is quite interesting in thinking about, okay, when we started, this technology wasn't available to think about how do you think about distributed trust, how do you establish an investor contract in a different way. We have a bond program, which is really traditional, which investors invest into, a loan program, which is also meeting all the regulations across multiple places. Is there a different way to think about that with the technology that's coming online now in smart contracts and blockchain, to do that a little bit differently? But the challenge for us is just that, because we set out with a pretty difficult mission of saying we're going to go for the world, we're going to go for the world, star, not Belgium or Sweden or Montana.
Okay, well, if there's anyone in the audience who has the ear of the Belgian or Swedish regulators, then please, point them in put a good word in their ear from Cameron. But that's all we've got time for, unfortunately. But really appreciate that fascinating discussion. That's Jeffrey Guigou from CEO of Younited Credit, Cameron Stevens, Prodigy Finance CEO, and Siroya, CEO of Tala. Thank you.